Good afternoon, everyone, and welcome back to this webinar where we will continue our look at smaller companies around the world. You may have noticed that US small caps had a significant bump last week, seeing one of their best ever one-day gains on record. We think this could be a sign that the environment is starting to turn back in favor of smaller companies, maybe in the developed world at least. Today, we're looking at the other side of the world and Asia. Like the US, Asia is also expected to deliver strong GDP growth in the coming years, which should provide plenty of opportunities for companies to grow their earnings. Shortly, I'll hand over to Gabriel Sachs, co-manager of abrdn Asia Focus, who's going to talk us through the trust and the current opportunity as he sees it. If you'd like to ask a question, please do. We have 15 minutes or so reserved for questions at the end. If you could put that in the box on the screen, which should be on the right, then I will put those questions to Gabriel at the end. So Gabriel, over to you.
Great, thank you, Thomas. Thank you everyone for joining today. As Thomas said, my name is Gabriel. I've been with abrdn in their emerging markets and Asian equities team for about 15 years. And I'm excited to talk to you about smaller companies in Asia, which I feel is one of the most attractive and overlooked parts of the equity markets globally. And interestingly enough, Thomas was referencing there how small caps have started to move in developed markets. In Asia, they've actually been doing very well and outperforming large caps. So that's something that we can talk about. Just very briefly, Asia Focus is a high conviction portfolio of smaller companies. In Asia, we've got about 50 stocks. And our approach is really to try and find the best quality small caps we can in what are the world's fastest growing markets. So we feel that we have a very rich universe to pick companies from. Just within the small cap benchmark, there are about 2,000 companies, but the benchmark as measured by MSCI anyway, doesn't include lots of companies that are in our universe. So again, a very rich and overlooked part of the market where there's a lot of hidden gems, poor analyst coverage, and that's something that we'll talk about. A lot of people talk about quality. That's really what we're looking for when we filter the universe. Companies with attractive industry characteristics, sustainable and business models with pricing power and strong balance sheets. And also, companies that have good governance credentials, management teams that we can trust, things that I think you will have heard before. If I just go into sort of why bother with Asian small caps, I think the reason really is you can access a very important part of the world and achieve higher returns at lower risk. So this is just comparing Asia Focus to a passive allocation to Asia, the mainstream index there, which is a large cap index. And you can see that you can materially enhance returns and actually reduce risk. Just to give you a little bit more detail on risk, I've compared here the 3-year realized volatility of Asian small caps versus small caps in developed markets. And what you'll see is that actually volatility or risk has been lower in Asia. So, there's this perception that Asia or emerging markets is higher risk, but actually when you look at the data, volatility has been lower. This is over the last 5 years or so. And in terms of the potential for outsized returns as well, just very simply, if you look on the left-hand side there, the number of analysts covering smaller companies in the region is very low. So only about 11% of companies in the large cap index have less than 3 analysts covering it, whereas it's closer to 40% in small cap land. And I think with things like MiFID and pressure on fees for the industry in general, I think coverage of smaller companies from the brokerage side has certainly deteriorated. So I think having a big team and having your own in-house capabilities to research these companies is a big differential. And then on the right-hand side, by their very nature being small caps, they tend to perform better, or some of the performance from some companies tend to be better. So there's bigger dispersion of returns in the small cap space. So the dark blue bar graph there shows the total returns for small cap, and then the light blue or lighter blue shows large cap. So every year, apart from 2021, small caps have outperformed. Obviously, the crucial bit here is picking the right ones that are part of that sort of portion that are outperforming. And if you look at a long period of time, this is from 2000, so about 24 years, you see that Asian small caps in gray have materially outperformed other equity markets. You have Asia large cap here in light blue. You've got MSCI USA, you've got MSCI World, and versus MSCI World is almost double the returns. Obviously, with any chart showing performance, it depends what period you are focused on. There will be periods where Asian small caps will have underperformed these markets, and obviously the US market has been very strong. But this is just to reiterate the point that Asian small caps have delivered very good returns at quite low risk. So probably won't spend more time on that. I think just on slide 7 here, just highlighting how differentiated the trust is versus the benchmark, both the large cap and the small cap benchmark. So whilst we compare ourselves to the small cap index, we are extremely different. Our top 10 is a third of the portfolio. It's only 2% of the benchmark. We won't have exposure to any of the mega caps in Asia, your Tencent, Alibaba, TSMC, Samsung. So it is a truly differentiated portfolio, with many of the companies there not being held or invested by mainstream Asian managers, given the size and liquidity profile of some of these businesses. So I think that's really what the trust offers that is different. I think just drilling down into sort of more recent performance and markets, as I said, small cap has been outperforming large cap in Asia, outperformance of about 25% over the last 3 years. We can talk a little bit about the reasons why. Two key reasons are related to the two big markets in the region. So China is a much bigger part of the large cap index. That's obviously been a tough market to invest in, or tough equity market over the last 3 years. But also you've seen a real boom in the small and mid cap part of the market in India. So these have been two tailwinds for the asset class. But outside of that, you've seen some ASEAN markets performing well, and individual companies that are more domestic focused perform well in what have been some turbulent times. And I think as a broad comment as well, whilst in developed markets, people have been very concerned about inflation and higher interest rates. Whilst rates have been high or higher in Asia than probably where they should be, given inflation is quite benign, the region is quite used to having relatively high rates. So it hasn't been particularly disruptive, and balance sheets in the region are very strong. So from an economic point of view, things have been pretty rosy in Asia, outside of China, of course, which we can talk more about. And on the next slide, you'll see that, again, when you talk about Asia, it's easy to think about it from a homogeneous point of view, but it is a very different, it is an asset class that has very different exposures to different markets that perform in quite distinct manner. So you can see here that India and Taiwan have been the strongest performers. India has really been doing very well on the back of political stability, a capex boom and investments that has been very supportive for the business community, and also, very strong GDP growth. And Taiwan's really been driven by AI and the tech supply chain, which again we can talk about. But Taiwan, has almost 30% market share in the sale of semiconductors. 20% or so of its exports are of integrated circuits, so it's extremely leveraged to the tech supply chain, and it's been very positive for that market. For obvious reasons, China and Hong Kong there towards the bottom, and also Thailand has been a laggard, given relatively low growth and also quite unstable politics, or at least a lot of noise around transition in government there. I think if you drill into the performance of the trust, the NAV over the last 1 year is up about 15%. Over on an annualized basis of the last 5 years, about 8%. Our benchmark here is the small cap benchmark, where we've been roughly in line with the benchmark over most time periods here. I also show the large cap benchmark there, which you can see over the last 3 or 5 years has really underperformed small cap. Over a longer period of time, the trust has delivered very good returns on a relative basis, but I won't drill down into this in great detail. But again, you know, the trust has been reaching, or will reach 30 years of history next year. It's been managed by Aberdeen since inception. And I think when it comes to the application of our process in terms of our quality approach, I think we have been probably one of the longest managers investing in this manner in the region in small caps. In terms of positioning and portfolio characteristics, we like to be diversified. This is on an absolute basis, our positioning by country and sector. India and IT are just under a quarter of the portfolio, so those are our two biggest exposures there. But broadly speaking, we like to keep pretty sort of balanced exposure and not put all our eggs in one basket. You know, we have historically had quite a large allocation to ASEAN or Southeast Asia, as well as India, and an underweight allocation to North Asia, which we'll see in the next slide. We also have an off-benchmark exposure to Vietnam there, about 7%. And you'll see here that China is quite low relative to most mainstream Asian funds. Given it's a smaller part of the benchmark, but also for us, it's never been a big market for us, given you know, in the small cap end, historically we struggled a bit with quality in China. We have about 8% there in China, another 7% in Hong Kong. So combined exposure to Greater China of about 15%. From a sector perspective, again, quite balanced, but quite light on materials, which is a sector we don't have a lot of exposure to and not super interested in as far as Asian small caps is concerned. On a relative basis, you can see here, as I described, we have a higher allocation to Southeast Asia, Indonesia there being quite noticeable as an overweight, Vietnam being off benchmark, and then an underweight to Taiwan in particular, and Korea as well. You know, the reason we're underweight those markets is, you know, they're actually quite large markets in the benchmark, but they're very tech heavy and very export oriented. We do like tech. We're very positive on semiconductors, but we're quite selective about what we buy, and we want, you know, leading businesses in their field. It can be a small field, a small niche, but we want them to be extremely good at what they do with high barriers to entry, good levels of profitability, and therefore, again, we're quite selective there. And beyond that, beyond tech, it's quite hard to get exposure to traditional industries that you'd want exposure to in more emerging Asian markets, like, you know, financials, consumer stocks, given these are smallish markets which are very, very mature, and therefore, you know, growth is much lower than, say, a retailer or a mortgage bank in India. And therefore, we see a lot of opportunities outside of tech and things like, you know, electric vehicles or high-tech sectors, essentially, or very industrial-based businesses in other parts of the region. And then on the sector basis, as I said, quite underweight materials, but otherwise fairly well spread. Our overweight to energy, I would say, is also a reflection of the fact that it's a very small part of the index at only 2%. We only have 2 holdings in energy in the region. And IT is an overweight, but it has come down a little bit. It was our largest overweight, but given performance has been quite strong from Taiwan, and we're quite underweight there, that overweight has shrunk a bit. I won't spend too much time on our top 10. I think just to highlight here that, as I said, it's about a third of the portfolio, so very high conviction portfolio. If you compare those top 10, they don't represent even 1% of the index. And some of these businesses we've held for many years, some decades since the inception of the trust, and some are more recent initiations, such as some of the tech holdings there, number 6 and number 9, which we've held for about 3 years. But again, a well spread exposure by sector as well and country, which we don't highlight here, so I won't spend too much time on that. Just to give a bit of an example on, well, I'd say that some of the themes that we're playing with the portfolio, one of which is just the middle class income growth in the region, and KFinTech is an Indian company we introduced to the portfolio earlier this year. Basically, it provides capital markets infrastructure for mutual funds in India. You can think of it as really doing back office work for mutual funds. And the nice thing about it is that it operates in a duopoly in India. There's only 2 companies doing this. They charge a very small fee, but make a sort of 45% EBITDA margin, ROE over 20%, and their fee is linked to AUM growth in India. And India must be the fastest growing asset management industry globally. You're seeing very strong inflows from SIPs, which are the sort of pension plans. People are allocating more and more on a monthly basis to equity markets. You're seeing that's on the right hand side there. On the bottom right, you see that individual accounts or investor accounts are also rising really fast. And basically, KFin is a direct play on this. And again, it is a duopoly with very high barriers to entry, given it is a very low fee that they charge. So it's very difficult for someone to replicate what they do. They're diversifying across different product segments. So they're going into alternative investment funds, pension accounts, corporate actions. So all sorts of capital markets activity benefits them. And you're not taking any individual asset manager risk. Aside from that, they're also going internationally into Southeast Asia, potentially into Europe and the US as well. So we see a long runway for growth for this business. It's only about 1.5 billion market cap. So a very small business with a very large addressable market. So this is just one example of the way that we're playing sort of wealth or middle class income growth in Asia. But some of the other themes that we like to have exposure to is the tech supply chain, where we think AI and CapEx in that industry is going to benefit companies in Asia, where most of these semiconductors and the supply chain is located. Also, in terms of nearshoring, where we have good exposure to Indonesia and Southeast Asia, which are benefiting from China plus one. And finally, the green energy theme, where you're seeing a lot of need for power generation in a cleaner way. So we do have exposure to that in the portfolio as well. But I won't go into individual examples of that as well. On the next slide, just in terms of portfolio characteristics, given the nature of the trust being very different to the benchmark, our active share is very high, 97%. I think historically the trust, most of the outperformance has come from good downside protection, given our quality characteristics, and we're a bit more defensive in down markets. So we only participate in about 50% of down markets. Sorry, the extent of a down market, we tend to participate about 50% of that. Although that's since inception number, I'd expect that number to be a bit higher today, where we capture a bit more of the upside and a bit more of the downside as well. Valuations look okay in our view, about 17 times PE for this year. That compares 15 times earnings for the benchmark. On top of that, you have a discount on the trust of about 16%. And what you get on the back of that is, very good return on equity, 18%, net cash balance sheets, and high growth. Essentially, if you look at the historic EPS growth of the portfolio, companies in the portfolio, about 25% per year. So I'll probably leave it at that. and move on to outlook and how we see the future. I think we live in pretty turbulent times. There's a lot going on, and frankly, we don't spend a lot of time purely on macro. We do have our global macro team, but our focus as managers of the trust is really on the companies, and the companies can behave and survive in any market environment. Having said that, and just in terms of that theme that we're playing, there is structural tailwinds for companies in Asia, just in terms of the growth of the middle class. And this is something that's been talked about for many years. But you can see here that about 80% of the global consumer class is in Asia today, and that's only going to grow given demographics and given the growth that we're seeing in terms of GDP. In terms of the tech sector, which is another theme we referenced, we are seeing an inflection. We have seen that already for a few quarters. You did see a bit of a hangover in the supply chain after COVID, given everyone was trying to get onto the cloud, invest in technology as fast as possible during the COVID years and work from home. And then there's been a bit of a hangover, but we're starting to see an upcycle in terms of CapEx. People have digested their inventories. Not people, sorry, the companies have digested inventories, and you're starting to see that CapEx turn. And there's still very long runway for growth across the different segments of the IT and semiconductor supply chain, given tech is really eating everything and being a part of all our applications, automobiles, and there's ever the need for more data. I think when it comes to individual markets, China has been the one market that's been a bit of an overhang on the region. For small cap, it's been less of an overhang, given it is a smaller part of the universe and the benchmark. But we still see a lot of opportunities in China. Household savings have increased materially post-COVID, and people have not started to spend that in a meaningful way. So you can see on the left-hand side there, deposits versus loans. So people are not borrowing and are keeping most of their savings. They're starting to spend it a little bit more, but there's still a long runway there for spending to pick up. And what you didn't see that a lot of people were expecting was a V-shaped recovery in consumption in China. And obviously this is a reflection of the fact that a lot of people are concerned about property and how much wealth they actually have and how much their properties are worth, given most of people's wealth is tied to property. But, I think when we look at the portfolio, one of the companies that we invested this year, for example, is a cosmetics business. And they're really a play on down trading to cheaper brands. They're taking a lot of market share from the European cosmetic companies like L'Oreal and Estee Lauder. When I say a lot, they're growing fast, but they're still only 2% market share. And we think that as a strong local brand, they still have lots of runway for growth. So even within a tough consumer and economic environment, you can still have companies that perform quite well and have a fantastic market opportunity ahead of them. China is today the biggest consumer market globally, ahead of the US, and there's still a lot of room for growth there. When it comes to India, there's a very strong economic backdrop for India. I think the IMF just raised expectations for growth to about 7% on a real term basis for next year. The latest quarter in India saw real GDP growth of 8%. The government is investing a lot in infrastructure and reducing barriers to doing business. And again, from a demographic point of view, there's a lot of runway for growth, provided India is able to create enough jobs for the people that are graduating. But I think so far the signs are quite good that the government is investing in the right places, and that there's a lot of investment from foreigners as well in trying to establish supply chains in India as they cool off on China, and the government has implemented these subsidy schemes for about 14 sectors, which is giving a lot of impetus for manufacturing in India at a very low cost. Obviously, there's a lot of countries that are trying to do that as well, but we do think that India should be one of the key beneficiaries of that. We did have elections in India, as you probably all know. The market did correct off the back of that, but bounced very strongly afterwards. I think the expectation is that it'll be more of the same going forward. I think personally it's a good thing long term that Modi didn't get a super majority, given it holds him back from pursuing the more extreme nationalistic agenda. And a lot of actually businesses that we speak to actually think it's a good thing as well. What could be a risk, of course, is if he has to water down a lot of the good reforms, structural reforms that he has to do. And one of the things that a lot of people have been talking about is whether he'll have to do more handouts and support the rural population in certain states. And that's something that could happen, but so far there aren't signs that he's doing that in any material way. And I think, he might have to do a little bit, but it doesn't change the picture again in a material way. So we're still quite positive on the outlook for India as far as the economy is concerned. And I think just on this slide, I think it's important to highlight that India is becoming too big to ignore in terms of the market size. If you look on the left-hand side, expectations are that in the next 2 or 3 years, India becomes the third largest economy globally. And if you look at equity markets, it's not very easy to see, but on the gray bars here, India has gone from being about 13% of the emerging market index to 23%. So it's becoming, incredibly material as an equity market as well. And potentially one that global allocators will start to look at on an individual basis, or will want to think about allocating to India, given the growth on offer and the size of that market. And then finally on valuations, I'd say that small caps in Asia have done quite well in aggregate, but valuations are still relatively well behaved around the 10-year average when you look at historical levels, and around the 10-year average when you compare it to MSCI World. This is all in PE terms on both. These are both the charts on the left-hand side. Obviously, this masks a lot of differences within the region. So Indian small caps are at the high end of those valuations. Some of the tech companies have rallied quite hard as well and would be on the top end of that spectrum. And then you have companies in Southeast Asia, in China, which are incredibly cheap. So obviously it depends which market you're talking about, but there is, in aggregate, I think, still a valuation appeal for the asset class. And in terms of allocations to emerging markets in Asia, this is really looking at it from an aggregate picture, so not even on a small cap basis, but dedicated allocation to Asian equities is less than 2%. Historical lows, EM allocations, as you know, is also very low. So if at some point this changes, you could see small caps become bid for again, given it is a bit of a forgotten asset class. And then when you look at, on the final slide here, on the portfolio valuations, I think we referenced this earlier in one of the slides with portfolio characteristics, but the portfolio trades at, if you look at 2025 PE, around 14 times, so next year's earnings, versus about 12 times for the large cap index and 13 times for the small cap index. The portfolio yields about 2.5%, which is not too bad given the growth on offer and good ROEs and strong balance sheets there. I think that brings us to an hour, which is what I was aiming for. So just to sum everything up, from a asset class and market performance point of view, small caps in Asia have outperformed large caps by about 10%. annually for the last 3 years, and yet valuations still look okay. The portfolio is pretty unique, very diversified versus mainstream indices and funds, with about 50 small caps that are very dominant at what they do and have very strong financial metrics. And then in terms of the outlook, that there's very strong structural growth themes for these companies and for the region. China is a bit of a headwind, or has been bringing the asset class down, but we do think that growth will stabilize there, and that there's a lot of negativity priced in. So, beyond that, we have about 85% of the portfolio invested elsewhere. So we still see a very positive outlook for our companies. And I'll just stop there and see if there are questions.
Great, thanks very much, Gabriel. If you're sitting in the audience and you have any questions, please do put those questions in the box on the right. We've got 10-15 minutes or so to answer all of those. We had a question about the market cap. What sort of range are you investing in, and what happens if a holding grows to a certain size? What are your rules on when you have to sell?
Yeah, that's a very good question, because we did change that in 2022. So I think when the trust first started, the market cap limit was $250 million, and then every few years we had to revisit that. So up until 2022, we had a limit of 1.5 billion market cap, which was actually quite restrictive, even in the small cap sense. I think if you look at most small cap funds, they'll have a limit in Asia and EM anyway, about 5 billion. So in discussion
sorry, Gabriel, this is US dollars, is it?
This is US dollars, yeah. But we actually removed the limit in 2022. So in effect, we could now invest in large cap as far as the mandate is concerned. But I think there is a very strong emphasis on smaller companies. So the rule of thumb that we have is really looking at the bottom 25% market cap of that country, because essentially the problem that we had was, a small cap in China is very different market cap to a small cap in Malaysia. A small cap in China is very much a $5 billion company, whereas our market cap limit was 1.5 billion. So it has meant that we have been introducing companies at the more sort of 2 to 5 billion market cap range over the last year. And that's really, I think, the sweet spot is really 1 to 5. And then we might go a bit lower than that if we find a very compelling idea. Given it's a closed-end fund, we can buy more liquid and smaller businesses. And then we might do a 6 or 7 billion if it's in a large market like India and China, and it still, feels like a small cap is still within the smallest bracket of the companies in that index. So I don't know if that helps, but it has given us a bit more flexibility there in terms of what we can invest in. And I think in terms of how long we'll hold on to it, I think the weighted average market cap of the portfolio is 2 billion at the moment. So it's gone up a little bit. It was probably this is in pound terms, probably about 1.3 about a year ago. So it's gone up a little bit, but we definitely get conscious when a stock goes over 10 billion or so to try and recycle that capital elsewhere. So off the top of my head, I don't think we have any companies above 10 billion, maybe 2 or 3. But I have to go back and look at that.
And you mentioned India and how positive you are on the long-term outlook. We had a question about why you're then currently underweight country. Is that a contradiction? Is that something that will change?
Yeah, this is probably what we've spent most of our time debating this year, actually, is we don't want to be too underweight India, but at the same time, valuations are a little bit stretched. So what we're trying to do is to wait for opportunities or diversify our exposure a little bit. We have been taking some profit from some of our Indian holdings that have done well, but we have introduced probably over 5 Indian companies this year So we are basically trying to recycle Indian capital into India and then also introduce a few more Indian names because, whilst valuations are high, we think a lot of that can be supported by earnings. But we are trying to be a bit more disciplined on the price we pay. So we introduce these companies at relatively small positions and then try to buy them on dips. So you saw a dip in February when the government central bank tried to put in place measures to cool the small and mid cap market specifically, and that lasted about 2 weeks or a week. So we did buy into that, and we also bought into the election wobble, but again that only lasted 2 days. So it's always difficult to chase a market that's very hot, and we don't want to chase it. But I think what's holding us back is valuations essentially. But it's where I'd say India is where we see the most excitement from a new idea generation perspective. It's where we're spending a lot of time researching companies and seeing, adding them to our pipeline.
And India's had quite a strong IPO market in recent years as well, hasn't it? Is that something that you look at, or do you prefer the more established businesses?
No, it's definitely something we look at. So we did participate in an IPO this year, a company called Bharti Hexacom. It's a subsidiary of Bharti Airtel, so it only operates in 2 states. It's a telco essentially. That stock has doubled since IPO essentially. So the challenge with the IPOs is actually getting a good allocation. So one of the things that we've been exploring, but it's taking a long time, is to try and do pre-IPOs in India, because we know we do develop relationship with businesses pre-IPO, and if we can do a late round just before IPO and to be like an anchor investor at IPO, that would be really helpful from an allocation point of view. The challenge with that is that it's taken a long time to get the license to do that. It's a different license, so it's taken us almost 2 years. I think we're almost there, but that would be helpful. But we have participated in a few IPOs. Most of them have done quite well for us, but we apply similar due diligence to IPOs as we do for companies that are more established in the market. But obviously, we have to take a bit more of a leap of faith if there's less track record from a financial, from an investment relations perspective. And yeah, we are always quite skeptical of valuations. But I think when it comes to India, actually the IPOs have been coming at reasonable levels, and then the market bids them up quite quickly. I think that's not the case when it came to the new age companies in India, probably 4 or 5 years ago during COVID, where everything was listing at very expensive levels. So the likes of Zomato, or the food delivery companies, the internet related businesses, those unprofitable tech companies, most of them are underwater. These days, the IPOs are coming at okay levels, in our view, anyway.
What is your view on currencies? Is this something that you have a view on, I suppose? So I guess we're all expecting US rates to be cut in the coming months or quarters. Do you expect this to have an effect on Asian currencies? And I can't imagine you have a view on GBP either, but given the trust is denominated, or at least US, the investors are all denominated in GBP. Do you have a view on GBP versus USD?
Yeah, no, we don't have a strong view on currencies. We obviously monitor the macro quite carefully. Frankly, Asian and EM currencies could have done a lot worse given how strong the dollar has been and given how rates have been. But actually, currencies have been relatively well behaved in Asia. Countries like Indonesia in the past have had pretty wild swings with the currency. You saw a little bit of that this year when they hiked interest rates off the back of higher for longer in the US. I think a lot of people are seeing that as a bit of a policy mistake, which spooked some foreign investors. But generally speaking, Indonesia has been also been pretty well managed from an economic point of view. I think the asset class has come a long way from the Fragile Five period when they were running, quite large current account deficits and financed by foreign flows. I think India was bunched into that. India is benefiting from quite a lot of foreign direct investment remittances, but also cheaper oil from Russia. So all of that has helped reduce the vulnerability of India to sort of swings in the current account and commodity prices. I think the big one from a currency perspective is probably China, actually, given potential for tariffs to increase if Trump is elected, and what the authorities there do in response to that tariff increase. There's some people that would say that they'll let the currency go and make their exports more attractive and offset that tariff increase. That's a possibility. I think our global macro guys will probably be releasing their views on that soon. But as you said, I think we do expect interest rates to start coming down in the US, and that should provide a positive backdrop for central banks in Asia to cut as well, which will be supportive of growth. So I think that sets the asset class quite well. But again, there's a lot going on, particularly if Trump's elected, which is a little bit unpredictable. So I don't want to say that we're exactly sure how currencies will behave and how the rate environment will look, but certainly our expectation is rates to start being cut in the US, and as a result, that will follow through in Asia.
We had a question about valuation when it comes to your stock selection, so your initial decision to invest. Is this something that you place a lot of emphasis on? And could you just talk us through how what you need to be comfortable with the valuation of a stock? Are you very conscious of that when you take an initial position?
Yeah, no, absolutely. I think we try not to box ourselves too much in the sort of value to growth camps. We're really trying to buy the best quality companies that are growing the fastest, the cheapest possible valuation. I think for some companies in the portfolio, particularly in China at the moment, the valuations are extremely attractive. We have companies yielding 10% or more, which we see as very attractive, and some of these businesses are actually very stable and not particularly risky. On the other end of the spectrum, we occasionally are quite happy to pay up a little bit if we think that we have confidence in the earnings outlook. So a lot of our time when we initiate a company is looking at what's priced in terms of market expectations. How can we justify these valuations based on standard multiples, but also in terms of sort of straightforward DCFs. When we initiate a company or initiate coverage of a company, we do a peer review with our colleagues. So we have over 30 people dedicated to Asia. It's about 50 if you include emerging markets. And every idea that's brought out to coverage, we share that research note, and it's essentially peer reviewed or assessed, and people ask questions and follow-up questions. So in that peer review process, it's quite a rigorous assessment of how the company stacks up, both from a competitive point of view, from a governance point of view, but also in terms of how comfortable we are with the financials and the outlook for earnings growth. And if we're not that comfortable, we'll do follow-ups with the company. We'll engage in some expert meetings with what we call sort of expert network providers, essentially, which can put you in touch with industry participants or people in that sector. So I'm being long-winded here, but we spend a lot of time on assessing our earnings outlook and how comfortable we are with that. And typically we try to be conservative versus the market, but occasionally if we're very confident, we might say, we're more confident than the market on these earnings estimates, so we're happy to pay up a bit. So I hope that helps give you some flavor.
Great. Got one more question from the floor at the moment, but if you're listening in and you have a final question, please do ask it now. Could you just talk us through the cost and the structure of the gearing and how that's changed in the last few years?
Yeah, so we have, I was going to go to the portfolio characteristics slide. We have about 10% gearing at the moment. There's two instruments, which basically splits that debt half-half. One is a convertible that was put in place a while back and that rolled over. That debt costs about 2.25%, and that matures in May of next year. So the board will have a decision as to whether actually that there's a chance that convertible converts to equity depending on where the share price is, but also we could redeem that or roll it over. So there's an open question as to what happens to that. And then the other half of the debt is a fixed structure that was put in place in 2022. That debt costs about 3%, and essentially the board were keen to lock in debt at low rates, which at the time I think was a pretty good decision. So we've got a 15-year note at about 3%, which we probably have over 10 years on that. We could increase that portion of the fixed debt. So potentially one option would be to, if we reduce the convertible, we could increase gearing on the fixed note. But that's all up for debate and obviously depends on board discussions as well. So I don't think the gearing will change materially, or at least won't increase materially. But there's a chance that it goes down if this convertible isn't replaced by other debt.
Fantastic. Well, thank you very much, Gabriel, for your time, for the presentation and answering all those questions. And thank you to the viewers for your interest. Jim, you did have a question on the absolute allocations to the countries, but they're on slide 14, and you'll be able to download that presentation from the website. Hopefully in the next day or two it'll be up there. So thanks once more, Gabriel, and yeah, I hope you have a great afternoon. Goodbye, everyone.
Thanks, Thomas.